Obviously, it's a realization that things have changed in the competitive space in China. General Motors, of course, started producing in China back in 1997, the second major foreign automaker to get approval to do that. Volkswagen was the first one. They had first mover advantage, obviously, in a nation that was, increasing its middle class. People were buying cars, but the competitive landscape, as we saw when I was there at the Beijing Auto Show back in May, the Chinese competitors have really upped their game. Also, they are pushing EVs. There's such a saturated market for the middle range, and that is where General Motors and its main partner, SAIC, Shanghai Automotive, really dominated for many years with sedans and the minivans. The GL8 minivan was the luxury, essentially the limousine of China. But things have changed dramatically. People are buying EVs. They're buying domestically made Chinese-branded EVs. And you can just see the numbers. Essentially, in the most recent quarter, ending June 30th, GM lost $104 million on its China business. China's sales plunging 29%. They sold 4 million cars in China in 2017, just 2.1 million last year. So that's about half. And that has to be reflected somehow in the changes that we're likely to see, according to sources. So, yes, they're laying off people throughout the joint ventures, but they're also said to be, according to these sources, going to be meeting with their joint venture partners like SAIC to talk about significant structural overhaul that could include capacity cuts going forward at its production facilities. So, yeah, big changes for GM.
And how much of GM's problems are perhaps also shared by other foreign car makers? You were there at the car show, for example, and the lineup was almost fully Chinese maker
All
EVs.
of them are faced with this serious problem. Yeah. I mean, Mercedes-Benz, obviously, the Germans are trying to figure out how to get their mojo back in the China market when all the press was really dominating by BYD. They right now sell about half of all the EVs in China, or about between 30 to 50% of the EVs in China. So it's all about EVs in China right now. Yes, the ICE, the internal combustion engine, is still sold, but again, the move is really towards those lower-end EVs, affordable EVs. They're selling EVs, Chinese makers, for less than $10,000 some cases $7,000. So, interestingly, SAIC GM Wuling is the other joint venture. They make the more affordable cars. Their sales dropped less than the SAIC GM joint venture, down just 12% sales in the second quarter. They make the Hongguang Mini EV. So that might be part of this structural rework, if you will, for GM to return to profitability, because they are bleeding money right now in the China market.